First rates Monday morning, we start a brand new week, bit of a back foot last week, but the bull market is still alive and kicking. All bull markets, they're correct, and typically what you see in a bull market is a very savage correction. The bank Nifty is last week, SBI, it came down. The Nifty did not fall because IT came for the rescue. So let's see, will it be Bank Nifty again? Because you don't have any large triggers, at least for the banking system per se. Anything negative in the credit policy may fuel downside momentum. Anything upside in the credit policy may not generate a lot of upside momentum or trigger because the Bank Nifty already isn't in record high. So that's the problem. I mean, now we are reaching that stage where a lot of good news is something which is not having impact on the market per se. It's a full house. When I say full house, near perfect market breadth. The bulls are occupying the front seat and the balcony seat this Monday morning. You've got the small cap index which is off to a good start, Nifty is off to a good start, banks are off to a good start, and the hero of last week, which is IRFC, that's up 3%. Suzlon up 1%, JP Power and Ventures up 3%, Reliance Power up by about 3%. Let's look at Paytm. Paytm Karo, that's the ringtone, don't we know about it? 9% higher. The overhang of Ant Financials is reduced significantly and 9% higher for Paytm. It will surely have an impact on Policy Bazaar, Paytm, delivery, just about everything where the FI ownership or the P ownership is there. I think the rub-off effect will be there. So delivery 421. You got uptick which is there in Zomato, which is at 99 now, almost 100. And you got Sterlite Technologies, which is trending up on very strong volumes. It's a good start, I would say. Benchmark indices are off to a decent start, and then you got on the losers, Cipla, the news what Somit just spoke about in terms of no new plant approvals could come largely because of that import alert. And then you got HFCL, which is at 70 rupees. Don't talk about it, but 70 rupees for HFCL. There is some news I don't remember, but the star today, hands down, I think is Paytm. And then what's fallen off the radar, Avan, is Adani Green, 9% down.
Okay, yeah, indeed. Today it's IT, media, metals, and it's pharma on the losing side. Yeah, Paytm sure is your star for the day. But check in on a lot of the other newsmakers. Aurobindo Pharma, they've got the US FDA nod for an injection. You've got something like a Balrampur Chini. A reaction to its numbers, margins have been very robust at about 12%. There is also got ICICI Lombard. That stock will remain in the spotlight as they've got the RBI nod for ICICI Bank to up their stake by about 4% in tranches. PG Electro came out with its numbers. It's been a healthy set of earnings. TCPL came out with its quarterly performance. Net profits have grown about 5% or so. Something like a Shipping Corp has come out with its earnings, so that too is going to be a result reaction. APL Apollo, Morpen Labs has been a thumbs up when it comes to numbers. Ethos has come out with a 42% growth in its net profits. Parag Milk margins as well have grown to about 94%. Mrs. Bector Foods, nothing short of an impressive set of numbers, and an Affle India as well as another result reaction. So quick check-in on all these. You flagged off Britannia, but that aside, Cipla, but that aside there's Britannia. It's been a disappointing set of numbers. The volume growth as well has been flat, and I reckon that will disappoint the street. Well, not so much. At least it's holding out in the green around the 4,800 mark. Bank of Baroda, the Q1 results as well have missed estimates. It's been a loss for BHEL and an EBITDA loss at that. You've got Delta Corp. Hardik Debar, by the way, has resigned as the CFO. That happened over the weekend or so, and that stock as well is at about 185. Fortis Health, Delivery came out with its numbers, a quick result reaction. Gujarat Fluoro, as well as Moltech and Gati, a net loss versus a profit this quarter. So lots of stocks that are in the spotlight. But Kunal, what's your first take looking at the screen and the market breadth?
Well, I think it's an okay start. I didn't expect too much of fireworks. I would still believe 90,600, 650 could be at max the upside for the index over this very short bounce for the index. In terms of opening trade, TCS is something which looks attractive. So we discussed a lot of these IT stocks previous week that these stocks are bound to get into a bit of a short covering mode. I think TCS is something which looks attractive from an intraday as well as from a short-term trading play.
All right, watch out for TCS. Naresh, let's quickly get in your top trade for the day, your first trade that you're punching in.
So looking at IndusInd Bank, the stock is shaping up for an eventual breakout move above 1450. Good relative strength in the last two sessions, so looks interesting.
Sunil Subramaniam joins us. Haven't seen and interacted with him in a while. And Sunil, so nice to have you back. I remember sending you a message for your son's wedding, and I'm still waiting and waiting for the mithai.
Well, after that, I had to rush to Singapore, and my daughter gave birth to twins.
Oh, congratulations! Then double mithai.
Now 3 mithais.
So when I come to Bombay to the studio, definitely.
I'm accepting courier services. I'm accepting Paytm.
Or even a treat on Zomato.
Even a treat on Zomato. Now you can order intercity there. Come on, not done yet.
But congratulations.
Old friends and triple mithai, and I haven't got a single one.
Done
So what have you
personally.
named your grandchildren?
Johan and Karan.
Well, God bless them. Congratulations once again. How things otherwise? How are markets looking? Is it getting too jumpy now, or do you think bulls can handle the heat?
I think the bulls can handle, because the bulls that we're talking about are actually the FII bulls. See, domestic SIP book is strong, and on lump sums there will be profit booking happening. But I see that only as a stabilizing factor. I think the prime driver for our market has got to be India's underexposure, if you see, related to China and related to other geographies, right? So I think the pool of capital that comes to India, right, is a fraction of what's there in the world. Now, that pool, if you look at hedge funds and active mutual funds, they will tend to take a call based on short-term things like oil price outlook and whether the interest rates are going to go up and inflation and all those trends. But there's one core, I would say almost more than a quarter of the FI flows are long-term flows. So to me, that shift from China, away from China to India, and I think the weightage in the indices, right, the emerging market indices will reflect that. Over the last 3 years, already India has more than doubled, and it will go even more. So I think that pool of capital is going to look at India as a long-term bet. And from a long-term perspective, I would say if you look at that pool, right, and it's always the TINA factor, right? Because liquidity, I don't see drying up in the global arena. As long as the threat of the war remains and the threat of, US data keeps surprising, but inflation attacking efforts will continue. And I don't see liquidity drying up this time. So from that point of view, if you look at India from a growth FII's perspective, the sovereign wealth funds, 6% GDP growth, 6% inflation is 12% nominal GDP growth, which should reflect in the stock markets. Take away 3 to 4% on account of currency depreciation, because even today, despite US interest rates, whatever they are, there's still a 3.5% difference between the US 10-year and Indian 10-year. So the fundamental currency story is one of 3 to 3.5% depreciation per annum. So from 12, if you deduct 3.5, you're still left with 8.5, 9% real growth of their capital. And for meeting the aging population there, the pension liability, the social security liability, right? There's no choice but to come to India to allocate a certain proportion, right? So I think that's what is keep the bulls. And the data on the Indian, if you see the earnings season so far, has been fairly healthy. It's quite good. So to that extent, I think that there will be corrections in the market. Markets by nature are volatile. There will be risk reward. There will be sectors going through overvaluation and then correction. All these things will happen. But fundamentally, if you look at it, the pool of stocks in India, first of all, is going to widen with newer and newer players, right? New IPOs coming in. So I think that there's no cause to be concerned for a medium-term investor in India, whether that's an FI or a domestic investor. So I would still stick to what I've been consistently telling you all. One is that keep your long-term allocation to equity always there. Don't ever pull it out, right? You need short-term money, you want to take it out, that's different. Number one. Number two is the fact is that in a market like India, right, the domestic market is the story of the future. See, the PLI scheme is getting manufacturing into India, but all those players who are coming are looking at setting up part of those facilities to cater to the largest population in the world, the largest middle class in the world. So the second is keep your domestic focus. Third, once you have a domestic focus, keep a broad market focus, right? I think if FIIs will come into large caps, but somebody has to sell for them to buy large caps. And I think that it's the local players, the domestic mutual funds, the domestic alternative investment funds, the insurance companies will keep rotating that. They will, as the large cap valuations go up, sell it to them and take. So I think keep a broad market focus, keep domestic. I don't see a cause for worry in terms of wealth creation happening in India.
Okay, that's the long-term journey. But let's look at next Short term, when I say short term, 3 to 6 months, and then 1 to 2 years. For me, short term is 6 months. For me, medium term is 1 to 3 years.
Okay.
I read a CLSA report in the morning which says that currently the valuations for Indian market are at a 15% premium to the historical average. And every time when you've looked at the historical averages and you've invested when markets are above the historical average, the future returns are not even in double digit for the next 3 to 5 years. How would you defend that?
I would defend that with the view that the dynamics at the ground are different now. Because when you take long-term averages, you've gone through periods when Indian economy was in downturn. You're looking at when the global financial crisis was there. So the average, it's like saying that the Ganga on an average is 5 foot high. So can I walk through it? Averages are very misleading in that sense, because the longer you take, the more it flattens out. But it's a fact that market, when they go through exuberance, irrational exuberance, ignore these averages and go and touch new highs. Now, what is the driver for those new highs? It is the flow of liquidity. So to me, I would say that if you go back to October 21 and you go back to December 2017, these are the two previous peaks of the market, right? And as long as the market is trading below that, right, I feel there's a chance for an upside. The same time, if you take the beginning of the year, Nikunj, around December, people were saying, 8% return is all you can expect from equity markets and 8% debt markets will give you. So it's time to move allocation to debt. I never heard a more foolish suggestion, because you are talking about the fact that liquidity, right, will keep on chasing as an alternative. I just explained to you the logic, right? If you get 8.5% from an Indian market, which fixed income market, which can compete with that? Yes, there'll be short-term corrections. So when you say that is 15% over longer-term average, I would still say it's still at a discount to October 21 and to December 17. And when the markets went to those levels, what was the thought process? Obviously, it was 25% above long-term averages then. So to me, the average, while it's a useful benchmark to think about how much you allocate or whether you take a 1 to 2 year call. So where this 15% thing comes, yes, if you want to take a 3 to 6 month call on equities, it is something that you got to look at multiple factors to decide whether this 15% premium is got to deter you. And I would say, yes, if you have a 3 to 6 months perspective on the market, then definitely you can't look to make short-term gains and come in, right? I agree with you. But even your 1 to 3 years time frame, right, I think is good enough to get you a healthy double-digit return from equities. It may not be the 20-25% which you've experienced at times in the past, but if you get 10 to 12% on a post-tax basis, you're still doing double of an FD or any other fixed income asset class. So I would argue that this encourages caution for short-term traders, but I would say it should not deter medium term. I will forget the long term now. Medium term, 1 to 3 years, it shouldn't deter them from an equity market allocation.
So, Sunil, then where in light of this are you sensing opportunity in the markets? Would it be to park it in some of the, marquee financial names? Is it looking good when it comes to sectors like capital goods, infrastructure, post the kind of Q1 earnings? Would you tilt towards defensives? What's the portfolio approach?
So I think that a 40% allocation to defensives, where I include FMCG, IT, pharma, and in that pack, and a 60% allocation to cyclicals, right? Here, where I put in capital goods, I would put discretionary consumption, which includes auto and housing, by the way. So into that bucket. So a 40-60 allocation. And the reason I put it that way is, despite being so bullish about the medium-term growth, the fact is that a portion of FII flows are passive fund flows, are ETFs, which buy everything in the market. So even a safety, which was underpriced, will go up because money is flowing into every almost sector. So I think a 40-60 ideally expresses the defensive versus growth perspective at this point in time.
Sunil, what would be the importance for next year's election cycle? Today we are not talking about it, but trust me, next year, same time, 9 out of 10 narratives would be centered around that.
So two things. Pre-election, there's always rallies because of 2-3 reasons. One is that liquidity spikes up in pre-election because of all the meetings and the cars and people throwing money at various things and government going into populist mode, distributing money into the people. So there's always a surplus of liquidity in the hands of investors and consumers. So both spending as well as investing gets a boom. So generally, I would say pre-election, there is always a rally, and I don't see it different next year. Second is, you are asking this at a very, very, in this moment, we still have the semifinals in terms of the Rajasthan, Madhya Pradesh, the big state elections yet to do. So those are going to play an important part in the sentiment and the confidence that the current NDA-led government can come back, and if so, with what kind of a majority. So I think it's still early days to look at how those semifinals have to happen. Those will have a key part to play on sentiment, whether you like it or not, right? Those election results will play a key part in terms of determining the mood. But what I mentioned here is that one of the things is if the government is going to allocate more money to consumption, and I do expect that to happen, because the second is inflation control. I think with the prices of tomato, now onions all going up, I think one of the biggest risks to any political formation is rising inflation during election. And I think that leave the state elections aside, I think the government has gone into an overdrive mode in terms of stocking up these various food grains and making sure supply is not an issue in the run-up to the election, right? So one, government expenditure will go up on buying them and storing them in FCI godowns. Remember the program they ran, something called TOP, tomato, onion, potato. These are three key vegetables which are very modern. They're banning rice export. So one is the thought process of the government, the behavior of the government is going to change. It's going to pro-consumption versus, to that extent, capex and infrastructure would probably take a slight back seat, because good governance and good development doesn't win you votes, right? It doesn't lose you votes, but it doesn't win you votes. But inflation can lose you votes. So this tilt towards inflation management and consumption, right, will be key drivers in terms of the stock market also, right? So I think that I don't see a concern about the elections, and I do expect a pre-election rally. Market will touch new highs before the election. Then, of course, the election result itself will have a part to play, which we are too far away to honestly take a call on that. Okay.
Sunil, appreciate your time, and thank you so very much for joining us, and I will be waiting for the mithai. Thank you very much. God bless your grandchildren.
Thank you.
Ajay Patil, CFO of Cummins India, joins us now. Ajay, good morning. Thank you for joining us. The Q1 revenue surged by 30% at an all-time high of 2218 crores. While the domestic demand was strong, the export was subdued. So do you think large part of this surge was only domestic in nature?
Yeah, I mean, good morning to you and to all the viewers. Certainly, as we said, the domestic revenue was driven by the pre-buy ahead of the CPCB 4 Plus transition, which was expected. On the export side, though, what we have been flagging is that if you would have tracked us over the last 6 to 8 quarters, we have seen that quarter on quarter consistently we have been ramping up our exports, primarily based on the efforts we've taken in the end markets as well as the demand coming across. But what we have been observing in the last 1 or 2 quarters was a kind of a softening of the exports. And that's exactly how the quarter turned out to be. The exports were flat to slightly down, especially within our export segment. There is a segment called low horsepower. That's where we expected that softening more. While the high horsepower and some of the other exports that we do, they continue to have quarter on quarter growth.
But why were exports down? I mean, is this a cyclical factor or will this come back?
I think our efforts are obviously to keep, working our efforts to, capture as much export demand we can. There is, of course, the bit of a timing or a cyclicality to it, especially in certain end markets where we have seen either through a combination of end market softening, to some extent the inventory rebalancing in the channel. So I do anticipate that over a period of time, this demand should slowly revive and come back.
Okay, fair enough. What about the outlook then for, when it comes to what you're looking at for the power gen business? Because that has largely seen a pretty decent growth on the pre-buy of the CPCB2 products. But after the pre-buy, usually we see that demand turns a little bit soft. What would that do to your overall demand? How are you looking at, Q2 FY24?
Yeah, so what we said in our earnings call also, our overall guidance for the year, we do believe that we'll, we are looking at our revenue growth, which is in excess of 2x of GDP. That's the guidance that we provided. Having said, the way we are looking at it, especially for the power gen segment, as possibly all of us know that the emission changes that were effective July 1st, 2023, there was a revised guidelines that came out from the Central Pollution Control Board, which meant that the CPCB2, which was the previous emission standard equipment, can continue to be sold up until June of 2024. So there will be a period of next, I would say 11 to 12 months where we have both emission product in the market available to the consumers. And so that's one data point. Second was the guidance that we are looking at from a full year perspective. And the third is purely from a demand point of view, when you look at the end markets. Given the economy holding up reasonably well, and the end market demand we have seen sustaining to a reasonable extent, what we would expect potentially is going to be some kind of an inventory rebalancing because of the pre-buy would have kicked in the prior quarter. That of course will take its own time to get to the system, and the new fresh orders which will start to come in. So in summary, when you look at it from a power gen domestic point of view, we still think that the end markets are holding up quite well, and therefore the demand should sustain for the rest of the year.
But if the outlook is robust and at a time when commodity prices were more like a tailwind for the quarter gone by, the margins have come down. 17 has become 13.
I think sequentially there has been, if you look at our, and we did explain that in our earnings call, was that there have been some one-offs in the prior quarter. So therefore on a sequential basis, certainly there has been a decline in the margin. But if you see it from a year-on-year perspective, I think we have expanded the margins quite nicely given the overall revenue leverage that we had. Going forward, our endeavor continues to be to deliver a quarter-on-quarter as well as year-on-year margin expansion. And we do believe that a combination of the efforts that we are taking on managing our costs, as well as the leverage that we are driving and the scale that is available, we should be in a position to sort of make all the efforts to drive our margin expansion.
If I draw your attention to what we are hearing from Cummins Global, they are not sounding very rosy or excited about the outlook. I understand the India business is different and I respect that. But if you have a parent which is giving not such a rosy outlook, what kind of rub-off effect it will have on exports? What kind of rub-off effect it will have on the industry?
I think what is the guidance coming out from a global, what you would have seen in their earnings commentary is a function of what's happening to the on-highway market in North America, as well as some of the end markets for the other businesses. If you keep that context there, and when you look at it from an India perspective, I think if we believe that the India GDP estimate, depending on which estimate we pick, is going to be between as low as 6.25% to as high as maybe 6.75 or 7%, and put in an inflation of about 4 to 5%, we are looking at our economic expansion of about 10 to 12% for current fiscal year as well as into the future. If that be the case, I think our domestic India market, we do believe will hold up. On the exports, we do believe that there are pockets where we will find opportunities. We have really fit for market products which we have launched in the last a few months, a few quarters, which are resonating really well with the customers. So I do believe that while there could be softening in some exports market, overall we should be still in a position to maintain our share of the overall export pie.
Confirming to us is that, look, the drop in exports for the quarter gone by, irrespective of what we are hearing from your parent in terms of the outlook for North America, your business in exports will come back.
That's our effort. That's exactly what we are working on in terms of trying to say how we can get back our exports volume.
Which I've always asked, and I've always got a response that we could consider it, we will consider it, but as of now there is no plan. And that is that why does Cummins in India operate through multiple subsidiaries?
I think it's because I would have possibly answered this before also when I have spoken to you. I think it's a function of what exactly the portfolio. We are in India for 62 years, and the portfolio of businesses which are part of the listed entity have maintained and have continued to grow. The unlisted entities are where some of the other businesses which are not part of the portfolio have come and grown. And I think that's exactly the way our structure is. Only because we have an unlisted entity has not in any way impacted the growth trajectory of a listed entity. So we'll continue to maintain that strong governance about it.
Wanted to also understand a little bit more about the margin picture. Yes, this time around on a sequential basis, they have reduced due to the wage increments and the one-time expenses. What's the trajectory down the line? You are maintaining just that 100 basis points year-on-year improvement in your margins down the line, and what will drive your margins?
That's our endeavor. That's not a guidance, as we clarified also. I think what we believe is that the on-ground infrastructure that we have from a manufacturing perspective, a very disciplined material cost reduction program that we have internally, which is quite well matured over the years. And we continue to manage our discretionary cost well. So in summary, it's about the key for us is to get the volume leverage that we need and then continue to do the way we do our cost management. And pricing, of course, the lag effect continues to benefit. So a combination of these three factors is what gives us optimism to say that we'll continue to look for ways to expand our margins.
All right, really appreciate your time, and so glad to have you on ET now.
Thank you so much, and always a pleasure speaking to all of you.
Well, I've seen tomato prices going up, but tomato and Zomato, they both are going up right now. And Avan, we're not getting into what happens with Zomato stock, but I'm telling you that tomato prices are ones I wanted to come down.
Absolutely not.
Let's look at Zomato. Actually, it's really been the star stock today. And star stock off late right now. But Mahindra & Mahindra, the stock is on a bounce back after the press conference and after the analyst call where brokerage is saying, okay, Mahindra & Mahindra is expanding, but right now let's focus on the core business, which is firing full cylinders. And that's what we plan to do. Rajesh Chirujkar, Executive Director and CEO with Mahindra & Mahindra, joins us now. Good morning. So nice to have you on ET now. Thank you for joining us.
And in our studios. Thank you for being here.
They're like boom time for SUV.
It is indeed.
And will the boom time continue for next 3 years, if I have to ask for that as a big picture scenario?
I think SUV as a percentage of passenger vehicles, firstly, it's more than 50% now.
It's crossed 50 now.
Yeah, it's crossed 50.
Last count was 40.
For the last year, I think the last quarter's crossed 55.
Wow.
And that's something which is prevalent around the world. So it's not like it was totally unexpected. Of course, in India, we have to understand that there are many SUVs which are actually crossover platforms, and that's enabling the market size to get bigger because they're able to come in at lower price points. So we are actually in a good place because we've been an SUV company all along, and we think this is a trend which will continue because the many things about SUV in an India kind of context. SUV represents much better status, ground clearance, sitting height. These are all very important for Indian customer space because of joint families or having visiting families. So several enabling factors, fortunately for us.
There are 40 SUV brands now, is what I've been told.
Yeah.
Everybody wants to have a piece or a pie of the SUV market.
Yeah.
That's a growing market.
Yeah.
When there are 40 brands which represent one category,
Yeah.
don't you think somewhere the pricing power will come back to the consumer in that case?
So I'm going to answer this question in two parts, Nikunj. One is, when you have multiple brands, it helps categories grow. So, and that's what we're seeing happen. In this crowded market, we've taken a very conscious call over the last 3 years in particular on the kind of SUVs we want to make. When you think about it, you may say that, if you're going to have a strategy which is very niche and you're going to have a highly differentiated, authentic SUV strategy, you actually can't get volume. Last 4 quarters, continuously, we've been number 2 by volume, over and above being number 1 by revenue market share. So even with our currently focused, differentiated, authentic SUV strategy, we are able to sell volumes and be at number 2 level in a market which, like you said, there are 40 brands. So I think pricing power will be around how much differentiation you try to bring in. And if you have a differentiated portfolio, customers will want to buy you. Our average XUV 700 price right now is more than 25 lakhs. We hadn't thought 2 years back that a Mahindra would sell at an average price of 25 to 30 lakhs.
You've taken the 50 to 20, 20 to 25.
That's correct.
25% is the net premium advantage, brand advantage you're getting now.
That's correct. So if you have a differentiated offering which is well packed, customers are going to be willing to pay for it. But that, like we've always said, that doesn't mean we go indiscreetly or recklessly and increase prices and lose the value proposition. It's about getting that sweet spot right.
But you don't expect any kind of an SUV war. I mean, The incumbents, can they come back? Can the Koreans come back? Can the Europeans come back? And what could be called as a price war? Maruti has triggered a lot of price wars in the past in the sedan market.
Yeah.
And now they are coming up with new launches because they have less than 20% market share in SUV. You are hitting them where it hurts them the most, the sedan market. So can there be a price war in the SUV market?
Once any segment is 50-60% of the overall category, which the SUV is right now, you would expect a high level of competitive intensity. I mean, you would, like you said, there are 40 brands. Why would not every player want to come in and be part of that game? So certainly we would expect high level of competitive intensity, and which is all the more reason our strategy is going to be about driving high level of differentiation, have a very differentiated portfolio, and do products which we believe go well with our brand DNA and which also appeal to the Indian consumer. So it's not like, okay, it's working in some other part of the world, so let's do that here because that's the platform we have or that's the product offering we have around the world.
What's the game plan when it comes to overall EVs in terms of the overall capex as well that has been lined up till FY27 as well? There were some ambitious plans here.
Yeah, so clearly we're preparing for an EV game, Avansh, and we've said that between 20 to 30% of our SUVs, we just spoke about the competitive strategy in the SUV game, would come from electric vehicles in 2027. And again, there we have a very differentiated EV offering strategy. We're not playing to the let's sell to those who want the greatest level of economic advantage. Of course, that would be a reason to buy, but to get that level of economic advantage, you need to be driving 150 kilometers a day. Not many people are going to do that. We believe that there are many other reasons why people will buy our EV offering. One is the design style, the standout look, the human-machine interface, which is, it's going to be a very software-driven vehicle. So that's going to be the basis of competitive advantage and differentiation. As you know, we've also done a second round of fundraise with Temasek, and which is valued that EV business is
15% higher valuation
than what we had with BII at $9.8 billion. Yeah.
All questions on RB will go to Anish, or can I throw one or two at you as well?
I will maybe quote unquote Anish as a reply. So go on.
No, my only point is that I've had the pleasure of tracking Mahindra and Mahindra for years now. And last 3-4 years, the capital allocation change has been fantastic. An absolute reboot in terms of capital allocation policy. For a group of your size, a small investment, how will this move the needle? Whether it's core, non-core, I don't know. But how will this move the needle? Because the amount of scrutiny you've come under because of the small investment of 450-500 crore, was it worth it?
Yeah, Nikunj, let's just try and recap, and I'm going to kind of play out some of the things that Anish has said on this over Friday, because this was a key topic of conversation across the meets on Friday. We've said we are not going beyond 3.5%. There's no plan to do that, right? So firstly, any speculation that may be there on what's the extent of deviation we may be doing from a capital allocation policy doesn't cross the 400 crores kind of thing. The second is, what Anish has said, I think, is that it gives us an option in case opportunities come up in the future. 400 crores is not a high amount of money to put in a business, in a sector in which we already have a market cap of 40,000 crores plus.
Yes.
Right? So if you're putting 400 crores in today, you have an option of seeing where does that go over the next 5, 7, 10 years, or you have an option of saying it's not going anywhere, we can get out. And we are very unlikely to lose money because we've bought in at a very attractive price. So I think Anish has been able to convince a lot of the analysts, and you're already seeing the impact of that on the stock market today.
If things don't work the way you're thinking, it may just end up becoming a treasury operation.
That's correct. I mean, on a treasury operation, you're likely to make money. And in any case, there could be an opportunity, as Anish has been saying, to help us learn the sector a little better in whatever way that conversation could go.
The same investment could have been done through Mahindra and Mahindra Finance also. Their balance sheet can easily absorb 400 crores. Yeah. And they could have also made the same treasury gain. For them, it would have been more strategic fit. And all the questions we are asking you today, if this investment would have been done in Mahindra and Mahindra Finance, those questions would have not been asked. How about that?
Nikunj, and again, this question has been answered, so I'm going to recap. It's for us as a shareholder to learn the business. and give the option of, as a shareholder, to decide what's the implication on Mahindra Finance if banking was to open up 5 years or 7 years later for non-banking financial institutions. And in that scenario, should Mahindra Finance move into becoming a bank or not is a shareholder decision, right? And we felt, since this is a shareholder decision not impacting immediate outcomes of a financial services sector, we as a shareholder should make that investment.
Just one follow-up question, and that's not about this deal, but in general about the importance of NBFC business. You need the NBFC business to sell cars. The second-hand business is doing very well. Is this also some kind of an indication that you're getting ready for the turf, which is that NBFCs up until now were given a lot of free hand by RBI, but stringent norms are coming? Maybe this is Mahindra and Mahindra's attempt to diversify their risk away from NBFC because you see the landscape changing in 3, 4, 5 years. You're preparing it early.
Yeah, I would just maybe paraphrase Nikunj to say we are preparing ourselves for future scenarios by way of...
That's a fair assessment.
And to say that we should, we spend 400 crores out of the, cash streams that we have, including not taking money away from Auto Farm to pay for this and paying it out of the services. I think it's, the way we think about it is a good thing to do to prepare ourselves for the future, and we have all the options to play that out.
Are we done with RBL?
No, you started with one question.
It's just that the answers were so interesting that I was intrigued. The answers were so important that I was just drawn into it. But thank you for patiently, agreeing to answer one, but actually answering 3 questions. Thank you very much.
Yeah, I'm not going to ask on that, so no need to worry. But it's been tractor volumes that have been surprising very well. There have been a lot of new launches. There's an increased distribution network as well. So in light of all of this, is this trajectory going to continue for tractor volume growth?
Yeah, so I'm going to answer in 2 parts. One is the tractor industry. Right? Tractor industry comes off a very high base of F23. We think that will be low single-digit growth. Many positive enabling factors in the rural market. The rains coming in July, even though a little delayed, has not affected sowing. So Kharif sowing is good. The Rabi crop last time was good. We expect government spending in rural to go up as we move into multiple elections, state and then national over a period of time. So several enabling factors. But right now we are not changing from low single digit for the industry because we would rather wait and watch, and we know that the tractor industry is on a high base. We've been gaining market share. We gained again YTD July about 0.5% on top of a very good growth last year. We see further upsides because there's a segment of the market, the orchard and the lightweight tractors, where we have a lower presence than our national market share. We've just launched Swaraj Target, a new product there, and we're going to launch the Mahindra Oja on 15th August. So we have 2 big launches happening in a segment in which our market share is 30% compared to our national average of 42%.
We look at, the car industry sales, the passenger car business growing at 4%, aggregate picture. But we look at the SUV market growing at a different rate. How much of this growth is also a factor of this demand squeeze or product availability squeeze which happened in 2021 and 22? So right now, are the numbers looking strong because you're adding more production and this is pure booking which is you're delivering?
For Mahindra?
For Mahindra.
See, right now our, even though we have a wait period, and that's why we started putting out new bookings on top of what's the open bookings. The new bookings for most of our products are still higher than our enhanced manufacturing capacity.
New bookings are still higher than enhanced manufacturing
capacity, right? So I think that's the key thing to track. So right now we're producing at 37,000 is what we did in July, which is very close to our current capacity. As you know, capacity will go up to 49,000 by the end of the financial year. Our new bookings are 45,000 plus, right? So the new bookings are higher than the rate of production. And hence, the waiting periods are still not coming down as much as we want to, because unless we are able to produce to beat new bookings and cover earlier bookings, you're not going to bring down waiting period dramatically. So that's the endeavor as we get to the next phase of capacity increase.
And I believe that the demand for the premium models like the Scorpio, the XUV 700, that continues to remain strong. Are you seeing sluggishness in any category like the Bolero, XUV 300?
Yeah, like I said a little earlier, the segments which are less than 10 lakh price points
That
have
is
been
where
slow
it's
for the
at.
last 12 months, and both Bolero and 300 are in that segment. And of course, there's even greater competitive intensity.
So where does that leave your overall EBIT margins at, looking at these metrics?
So, we did very good auto PBIT margins, as we call them. We were last year Q1 at 5.3, and this year we've gone to 7.5. 7.5 is close to our F19 level. Now, when we look at margin as a percentage, as we often have said, when you're in an inflationary situation as we are, we've seen commodity increases of even now adjusted level 15-17% after the correction has happened, plus BS6 that happened in the March of 2020, and then BS 6.2 now. So there is commodity, and then there is product change for regulation. We're still able to maintain a percentage margin of what we had in 2019. So I think we've done very well through managing model mix and pricing and overall cost to be able to get there.
Till August is perhaps one of the biggest month for SUV launches. That's what industry tells us in terms of what the industry would be launching. Historically, we've seen that the attention and the market share always gravitates towards new launches. For example, you ruled the market in 21 and 22 because of new launches. How will you counter with the new launches which now are A, coming with an edge, B, they are coming with the fact that the peers and the industry knows that, look, this is the product available in the market, we need to do it better in terms of modification or in terms of the pricing?
Yeah, Nikunj, you're right that new products always tend to get an initially high traction, and we've seen the benefit of that as well. We've had our share of that too, and maybe one may want to call it a variant, but we launched Thar two-wheel drive in January. Yeah. We were able to launch that at a sub 10 lakh price, and that's what helped get Thar into momentum, right? So a new product doesn't always have to be something completely new. If you're able to create a proposition and a
like Scorpio you did.
Yeah, Scorpio N is now just a little over a year old, so it's not certainly not in the old category. I don't think we've fully leveraged the opportunity of that. The interesting thing in our portfolio is we have Bolero, which is 23 years old, and still remains 9,000 plus. It was launched in 2000. The original Scorpio was launched in 2002, and Scorpio Classic demand actually went up with the refresh that we did, and after we launched Scorpio 9, so Scorpio N. So in our kind of products, because of the kind of customers we have, we actually don't see our products going to decline like a lot of the others, because the differentiation is so high that customers are buying us even more with time than they would, out of the new, okay, here's something new and let me just go and do one quick flirtatious swing there.
So just to bring it for our viewers, if I look at the platforms you have, Scorpio is a platform, XUV 500, XUV is a platform, Bolero is a platform, Thar is a platform. You are in no hurry to launch any new platform per se, and your existing platforms you think will have at least 3 to 5 years of shelf life. They may have, variations here, engine size, chassis size, those are variants, right? Yeah. Thar will become 4 doors, what I've been told. Those are all platforms. Those are all incremental changes.
That's correct.
But your platforms you think are built to last for next 3 to 5 years?
We think our platforms are built to last for longer because unlike the past, this time we've done very good work over the last 5 years in creating very future-ready platforms which are very lightweight, very good powertrain solutions, both gasoline and diesel. So at least 5 to 7 years plus, we don't think we need to do anything on platforms. We're going to be basically creating products on these platforms. In the ICE world, we're creating new platforms on the EV space. As you know, we're going to do the INGLO platform.
I've been told you got hard stop now, but you got 30 seconds and Avan does not drive a SUV. Why?
Really?
Here's someone, she never drives a SUV. So maybe a 30-second sales pitch.
Sales pitch.
No, so if I have to sell you one product in our portfolio, it would be Thar. And
I need a test drive.
That's done.
Okay, thank you so much
Thanks.
for stopping by and being with us and really clarifying a lot when it comes to your tractor volume, your business, the RBL stake, etc. That's the management of M&M speaking to ET. Now, where's the stock at? Well, 2.7% higher. 1505 is where M&M is currently at. The rest of the market, though, we're continuing to linger in a very tight range. It's 19,540 levels. It's only the small cap end of the market that's showing you a little bit of fervor, if at all. Tell you what, let's get right back to our chartists and get those chartbuster ideas going then. And Naresh Mirani is right back with us. So Naresh, let's start off with you, your chart of the day.
So that would be a chart for Federal Bank. Now, if you look at the stock, it has been a relative outperformer in the small cap banking space. Now, over the last 6 months, the stock has been in the consolidation. 120 has been the base, 120, 25, almost 5 to 6 bottoms around that area. And on the upper hand, 138, 140 has been a resistance for the last few months. So a tight range being formed, and it keeps on getting into be a smaller and smaller range. I would expect it to eventually break out on the upside of 138, 140 and accumulate at 128 to 135 levels with a stop loss at 122 and a target price of 150 to 180 in the short to medium term.
There you have it. That is Naresh's chart of the day, Federal Bank. Let's also map out your top recommendations, Naresh.
First is the buy on IndusInd Bank. The stock is again setting up for a fresh trend above 1450 levels. Good price action on Friday, showing relative momentum. Stop loss at 1360, target price of 1550. Second is the buy on Power Grid, which has corrected from 265 to 68, down to 247, 248 levels, playing for a bounce. Stop loss at 244 and the target price of 260.
Kunal is also with us. Kunal, let's find out your chartbuster call of the day.
Well, it's a chart on Indian hotels and how the stock has been consolidating into a trading range. But what I'm showing is an interesting history for the stock price of how it goes into multi-month time-wise consolidation. So this is the charts for the last 2 years for Indian hotels, end of 2021. You see a phase of the stock going into a rally. This is a strong rally for the stock price. And what follows post that is almost a 3 to 4 month of consolidation. So you can see the stock confined into a range closer to the 200 levels. Migrates higher, moves from 200 to 225 odd mark, again consolidates into a huge band for the next 4 or 5 months. We've seen that happening in 2022 mid, the stock migrating to a range of 250 approximately, and here the stock trading into a 7 to 8 month of consolidation closer to this 300 mark, which means this time around it's also very similar for Indian hotels, that the stock is going through a similar kind of a time-wise correction at this 400 level. But does it mean that it is bearish for the stock price? At least the history suggests that it's not bearish for the stock price. The only concern is that how much time the stock would spend. As of now, it's just been 2 months of consolidation, which means we can expect at least another 1 to 1.5 month of consolidation further for Indian hotels. And going with the previous history, expecting that the stock would break out of this 450 odd mark to move up higher to almost 500. That's the next club for Indian hotels.
All right, that's interesting, mapping the trajectory of Indian hotels moving from strength to strength. But let's also find out what are Kunal's top recommendations. Kunal?
So 2 buy calls. The first one is by Balman Lorry, mid-cap name. The stock looking attractive, in fact giving a fresh multi-month breakout, targets of 166, stop loss at 150. And the second would be a buy on PI Industries, again a swing breakout on the daily charts, 3900 as the target, stop loss at 3690.
Thanks for that. Yatharth Hospitals, that's new listing that's flashing at the bottom of your screens, and it's been a very decent premium of about 12% or so to its issue price of 300 rupees per share, and that was the expectation that we could see a double-digit premium this time around. There have been very strong subscription figures that we've seen. It is a prominent super specialty provider in the Delhi NCR region, diverse specialties, strong payer mix, consistent operational and financial growth, which is why that is seeing a good listing. 338 thereabouts is where it's currently at. Tell you what, we'll slip into a very short break. Be right back as we connect with the management of Yatharth Hospitals.